There we go. And I'm now recording this session. So given that I'm at school, it's I can do this process a lot easier. So tonight's session will be recorded. Oh, no problem. Oh, you know, you might turn off your audio if you could. Yes. Yeah. Sometimes when you have two audios going in here, you get that nice feedback going. Yeah. So.
Hi, Steve. Hi, Steve. I'm here. Can you hear me?
Yep. Sure can, Austin.
Okay.
All right. So, yeah. So there will be a recording of this that I'll post a link to, and you'll see an update, I think, through Canvas, so that you can get to it if you want to view it again. And I'll do the same for last week's class session. So, and I do have a special announcement that I'll make at the end of class today. So you can wait with bated breath for that announcement. But today, so basically today I wanted to go through the material in Chapter 2 that I want you to be familiar with. And also get in and do a reading, a short reading from Chapter 2 on securitization. And I'll talk about what that is when we get to that point. And then we'll have a discussion about that. And then I also want to try to tackle most of chapter, or at least the financial statement portion of Chapter 3 tonight. So it's fairly ambitious. We'll see how far I get. But so I may be sort of using the fire hose method of teaching tonight, where I spew a lot of information out and I hope it sort of sticks. And I'm going to be doing this maybe fairly rapidly. So if you have any questions, just interrupt me. I try not to get going and lecture for most of the class, but in some cases like tonight, there's just a lot of information I want to get around to. So I'm going to do that a little bit more tonight. So, any questions before I just launch into Chapter 2 tonight? Let's make sure I got this up. No? Okay, and, okay. Or did I not? I'm sorry, I didn't post week 3 or publish week 3 in Canvas. So I just literally clicked on publish. So if you were looking for this week's updated materials in Canvas, it wasn't published until 5 seconds ago. So I'm going to be using some of the resources tonight in some of my discussions. So if you can't get access to it and you were already logged into Canvas, you might just need to log out and log back in to get access to that. So, okay, so here we go. No questions? Launching into the second chapter of the text. So the second chapter really, it covers descriptions of different types of financial markets. It covers descriptions of different types of financial institutions, how companies raise money to expand, to build a new factory, to pay their CEOs very high salary. And so we'll talk about that, and we'll talk a little bit about stock markets and just definitions of stock markets in Chapter 2. So. And again, these readings, all the readings through Chapter 3 are going to be on Canvas. So I've scanned them and put them on Canvas. But after this week, so Chapter 4 on, you'll need a book for the reading. So I'm just forewarning you. I think I hope everybody has ordered or has a book already. So you should be good to go. So in Chapter 2, I just wanted to start out by showing a figure 2.1 and discussing it. It talks about how essentially money gets to a business, and there are a few different routes for it. So let me share my screen here. Share screen. Okay. And so these are sort of the different methods for money to get to a business from savers. And savers are anybody who invests money in a stock or a bond, anybody who puts money in the bank, anybody who buys mutual funds, or anybody who makes a direct investment or a direct loan to a company. And so
if it was my business, would I be the saver if I'm using my own personal savings?
technically, yeah. Yeah, because any business needs even a minimal amount of resources to start. So if they come from you or your family, then you technically are the savers. Yeah. Okay. Let's see. So where was I? So we have 3 different methods here that the book describes, and these are just sort of maybe the most basic methods of getting money from a saver to. And I'm just gonna. Okay. So the first is direct transfer. And the direct transfer method is just when you as an individual, an investment company, as a stockbroker, purchases a stock or a bond of a particular business. And this happens the first time a business issues securities. So we're going to talk about IPOs, or what are called initial public offerings. In other words, the first time a stock has been offered, or a security, whether it's a stock or a bond, has been offered. But typically they refer to IPOs when they're talking about stock. And again, maybe I'll just quickly define these to make sure we're on the same page. The difference between a stock and a bond. They're both securities. So, but the difference is that a stock is you become a part owner of a business. It's probably a very small owner unless you purchase thousands and hundreds of thousands of shares, but you were an actual owner of that business, even if you purchased just one share. So that is a stock. You're purchasing a part of a business. So when Facebook did their IPO and they raised, I don't know, $10 billion or however much money it was that they raised, because Facebook was private for a long time. It was owned by Mark Zuckerberg and an investment firm, and they were the only 2 people who had ownership in Facebook. And then it got big. And so they decided to do an initial public offering. So they wanted to sell stock on the NASDAQ stock exchange, which is one of the stock exchanges in the United States. And so what they do is they work with an investment bank. And so this is actually more accurately number 2, indirect transfers through investment banks. They work with an investment bank to put together a stock offering that says, we're going to sell shares in Facebook initially at $45 a share, or whatever it was. I'm not even sure what the price was initially for Facebook. But they set this price. And this is the first time that Facebook has offered shares for. And so certain investment banks, brokerages, and big investors get an opportunity to purchase these shares prior to them trading on the NASDAQ market and going up and down and up and down, or like they did, just go up. But the investment banks puts together this offering, and so I think Facebook sold like they might have sold 49% of the business. They offered that amount out in shares. And so they probably, I don't know the number of shares that Facebook had their initial public offering, but it was in the millions, certainly in the millions, literally 10, 15 million shares, individual shares. And so what happens at that point, if you buy a share, you own part of Facebook, a very small part of Facebook. But it also means that you can go to the annual shareholders meeting, even if you own one share, typically. And you can vote on the board of directors election and other things. However, usually the big stockholders are the ones that hold the most sway, because you get one vote for every share that you own. So if you own one share and say the University of California pension fund owns 15,000 shares, then they have 15,000 votes to your one vote on items at the stockholders meeting. And so, but it's a very small ownership share. Bonds, on the other hand, don't convey any ownership. You do not, if you buy a bond for Facebook or any other company or a government, because governments issue bonds frequently, you don't own part of that entity, but what you do have is you have a promise to pay. A bond is essentially a loan. When you invest in a bond, you are loaning an entity money, whether it's a business or the government. So for instance, right now in Bellingham, there's going to be an election next month in early February to do a levy or a bond to raise funds for school operations and technology for schools. And they're voting on whether or not the school district can issue a bond that's based on property taxes in the Bellingham area. In other words, people's property taxes are going to go up some amount if these bonds pass. But really what any bond is it's just a promise to pay. It's a loan. So if you give, let's say you buy a $1,000 bond in IBM, computer company, typically what happens is bonds have a certain maturity length or a certain amount of time until you can redeem them. And so if it's a 5-year bond, that means in 5 years, IBM should pay you back your principal. And in the interim, or at the end, depending on how the bond is set up, you'll be getting interest on top of that principal. The principal is the $1,000 that you loaned IBM. Some bonds are for 1 year, some 2, 5. There are government bonds that are 10-year bonds. There are even 30-year government bonds, and they pay different interest rates depending on the length of maturity. And by the end of this class, we'll look at the equation that will allow you to calculate what an interest rate for a particular security should be based on certain variables. So, but that's at the end of the class. So, but anyways, a bond is just a promise to pay. It's a loan to a company or a government. So, so a company can raise money in those ways. They can either issue stocks, they can sell out part of the company, they can give up ownership in it. Like Facebook, they sold 49% of the company essentially. That means that Mark Zuckerberg and his investment partners still own 51%, which means they control the business. That happens a lot of time. If they don't need all the money, they will maintain a majority ownership in the company, so they can still make all the decisions because they have 51% ownership, but they've just raised a lot of money by selling off 49% of the company. So it's a pretty typical.
So if somebody had enough money, could they buy all that 49%, and then they have all that 49%?
Well, they could try, but what would happen is that, well, first of all, they would have to find people who would want to sell. And some people would be willing to sell at, say, 30, but others would want to hold it to 35. Some might not want to sell until it's like 90. And so you could put these offers out there, but the price would just keep going up and up and up. And so it's not like if the stock is trading at 35 and you have $40 billion and you say, I want to buy all this stock at 35. First of all, the only stock available to buy is the one that investors, stockholders put out there for sale. So there's a bunch of stock that's not on the market for sale because there's not sell orders out there. And so the price would just keep ratcheting up. And so it would be very unlikely that one entity could get certainly 49% or all of the public stock of a company.
So there's just more traders involved. If you want to do it, you have to contact all of them all at the same time, and that's even if they're willing to do so.
Yeah, and it wouldn't even be a matter of really contacting them because the stock is sold on a public stock market. You could just buy what was on that public stock market at that point in time. And so, yeah, that's certainly if you knew individuals or entities that held large stock positions in the company, you could contact them directly, but typically that's not how it's done with a publicly traded stock.
Wow.
Yeah. So, so anyways, that's stocks and bonds. So getting back to how money gets from savers to businesses. This is one way. A business can sell stocks or sell bonds, and they'll raise money that way. They have to pay back the bonds. They don't have to pay back the stocks. They just sold off part of the company in exchange for money. Typically, the first time that, or always, the first time a company sells stock on the public market, they will have an investment bank, which is not a regular commercial bank like Bank of America or U.S. Bank. It's a bank that all they do is they set up securities offerings. So offerings for stocks or bonds or other very complex investment securities. So they don't take deposits. You can't go in and open up a savings account at Goldman Sachs. So Goldman Sachs is probably the most well-known and maybe the most notorious investment bank. But they set up these deals, and they typically get 3 to 4% of the value of the stock offering. So in the case of Facebook, the investment bankers, and it's likely that there was more than one, but the investment bankers, if they raised $50 billion, the investment bankers made $1.5 billion in fees on that, just providing that service. They didn't even have to buy any stock. That's just what they make. So investment bankers can get obscenely rich. So the investment bankers sit in the middle here. They sell these securities, these stocks or bonds, to savers. The savers pass back money to the investment banks, who then pass the money to the businesses. And I guess the first part I missed there. The businesses sell the securities, or they develop the securities with the investment bank. They go to the investment bank, and then the investment bank sells it to the savers. And so this is how the money, securities go out, money comes back in this way from savers to businesses. So that's number 2. Number 3 is, the best example of this would be mutual funds. And have I described mutual funds in this class? I feel like I have, but maybe not. No. Okay. So a mutual fund essentially is I think I talked about it a little bit, but a mutual fund is a company like Vanguard is a huge mutual fund company. They may have 400 or 500 different individual mutual funds that you can invest money in. They typically have a fairly low minimum investment, so maybe 500, maybe only $100. You can invest in a mutual fund, and what this mutual fund is comprised of is a bunch of different stocks that Vanguard selects that they think will do well, and or bonds, or a combination of stocks and bonds. The mutual fund is this financial intermediary piece right in here. So they will buy stocks from, if it's let's say a technology mutual fund, they will buy stocks from Microsoft and Google and Intel and whoever else they want to buy stocks from, and they'll put it all together in this one fund, mutual fund, and then they will sell this to individuals who want to buy into a security, but maybe who don't have the thousands and thousands, tens or hundreds of thousands of dollars it would take to put together a portfolio buying the stocks themselves, right? So if they buy one share of the Vanguard Technology Fund, they will own like 0.005 shares of Microsoft, 0.01 shares of Intel, or whatever it is. They'll earn very small parts of shares of these businesses. But the advantage of mutual funds for the small investor is it allows you to diversify your risk. So if a mutual fund buys 100 different companies in the technology sector, or any sector for that matter, then if one of those companies goes bankrupt, then they lose their entire investment, everything else being equal, maybe you lose 1% on your investment because you have 99 other companies that didn't go broke. If you yourself as a personal investor put all your money into one company and they go broke, you lose all your money. So that's called, that's diversifying risk, diversifying company risk in this case. Not putting all your eggs in one basket is a great way to think about it. And so that's what mutual funds do. They allow you to get that diversity of investments without having to have tons of money to do it. And so they will buy, this mutual fund will buy these securities, these stocks or bonds over here. Then they will sell them to people over here, and savers will buy them. And the price of the mutual fund will go up and down depending, just like stocks and bonds, depending on supply and demand. So if more people demand shares in this mutual fund, then their price is going to go up. If less people demand shares, it's going to go down. And so the savers give Vanguard Mutual Fund their dollars. And then, well, as this part of the equation for Vanguard buying the securities in the first place, they provide the dollars to the business. So that's sort of how that works. So those are sort of three ways that companies can, three most common ways that companies can raise money. Anybody have any questions about those? No. One of the things I mentioned last week when we talked about different types of companies, if a company is going public with stocks or bonds, they have to be essentially a C corporation. So that's the only type of company that we're going to be talking about in this class that can sell stocks on the public market to thousands and thousands or millions of investors. So this is C corporations here. Okay. No questions?
Who gets the first dibs on the stock after, like, the CEOs and stuff? How do they know how to spread it out and so regular people can buy the stock? Like the financial intermediary, which is the mutual funds, do they get the first dibs? Or is there like a committee, like all these people are going to get it and then you guys divvy it out? Or
typically it's decided by the business in conjunction with the investment bank who's putting together the offerings. And the investment banks will typically give the opportunity to buy shares the first time, the IPO shares, to other financial institutions who are going to buy thousands of these shares, other big time investors, pension funds who invest a lot of money. So it typically goes out to brokerages and other investment firms who then may provide the opportunity for some of their clients to buy an IPO. But it's typically the big boys who get initial access to it.
Okay, cool.
Okay, so that is that. So I'm going to talk about the different types of markets that there are to trade different assets, typically for money. In all cases for money, because we're not going to be talking about bartering. And this is, again, this is covered in chapter 2. And so what they do in this chapter is that they give you two examples of two different types of markets. They contrast them. And so I'm going to just follow that lead, do the same thing. And so these are just different ways of describing markets, trading markets. So the first way they break it apart is they have physical asset markets versus financial asset markets. So physical asset markets are markets that trade in actual tangible goods, like real estate, machinery, pork bellies, corn. Commodities are one example of physical asset markets. So anything that has a tangible form that you can touch and feel and buy, that's a physical asset market. If on the other side, the financial asset markets are things that we typically identify as stock markets. So where you trade stocks, bonds, and other types of financial securities. So New York Stock Exchange, NASDAQ, those are financial asset markets. So you're trading something that's worth money or value but it's not. It doesn't represent a physical object. It's more of a it's a right to something. In the case of a bond, it's a right to get amount of money back and get a certain amount of interest. In the case of a stock, it's the right that you own part of that company. That is your right. So very small part. So that's two types of markets. Another two types, there are spot markets and there are future markets. And this is really easy. This is just a function of time. Spot markets are markets where you buy something right now. So that would be the commodity exchange when they sell pork bellies or oil or grain, wheat, for delivery, literally contracted delivery right now or in the very near future. Those are spot markets. Contrasting those with future markets, you can buy things to be delivered, say, in 6 months, 9 months, 12 months. And so those are called futures markets because you're not buying something today, you're buying the right to have that delivered in so many months. So typically resources like oil, other commodities, literally pork belly, beef, corn, wheat, you can all buy contracts, futures contracts, to acquire them at a certain price 6, 9, 12 months from now, however, whatever the time periods available in the market are. So those are two, that's another way to distinguish markets. A very important way to think about a market is when we talk about money market versus capital market. And this is pretty easy to distinguish. There's a lot of things in accounting and finance that hinge on the 1 year period of time, and this is one of those. So money market is the market for finance, for funds, for any period of time less than a year. So if you need a loan, if you're selling a bond that's less than 365, that you'll redeem in less than 365 days in 1 year, that occurs in the money market. So the U.S. government has what they call T-bills, treasury bills, for literally 30 days, 60 days, 90 days, 6 months. And those are all traded on what would be considered the money market because they're due in less than 1 year. On the other hand, the capital market is thought of as long-term. So anything over a year, if you get a loan for a house at 30 years or 2 years, or any other loan that's above or that comes due in a greater period of time than a year, then that's on the capital market. And so things like bonds, for instance, this Bellingham School levy bond, I want to say it's a 7-year bond. I'm not sure, but it's 5 or 7 years. So it will be payable in 5 to 7 years. So that sale occurs on the capital market. And we're going to be talking about going through and really hopefully re-describing for you the different financial statements later tonight. One of them is the balance sheet. And on the balance sheet, they have short-term and long-term assets, and they have short-term and long-term liabilities. Both of those also revolve around the 1 year mark. And so that, again, just sort of keep that in mind. It's a good metric to distinguish between types of loans or investments, short-term versus long-term. Sometimes they have a little bit different verbiage, like sometimes they'll call short-term assets current assets, and they'll call long-term assets non-current assets. But essentially what they're describing is a short-term and a long-term asset. So there will be one exercise as part of an assignment that'll be due next class that specifically has to do about identifying whether an investment is a money market or a capital market. So heads up on that. Let's see. We have another way to distinguish markets is whether or not they are a primary market or a secondary market. And primary markets, the way to remember these, or it's where IPOs happen. It's where the first time the sale of a stock happens. That's considered a primary market transaction because that stock or that bond has never been traded before, at least that issue of stock and bonds has not been traded on the open market before. So that's a primary market transaction. IPOs are. Secondary market transaction is like Microsoft has stock out there and I go out and I buy 10 shares of Microsoft stock that's already on the open market. That's a secondary market transaction. So any security that already exists, that's already been issued and has been out there, those transactions are considered, they occur on the secondary market. And sort of the last way they distinguish between markets is private markets versus public markets. And so public markets are what we've been talking about, markets that anyone can, any investor really can have access to and can buy securities or other things on. So the New York Stock Exchange, the NASDAQ, the Chicago Board of Trade, which is where they trade commodities. Those are all public markets that anybody has access to. So those are considered public. Private markets are markets where the asset being sold or the transaction itself doesn't occur in an arena where anybody can get access to that information. So one example would be for a private market transaction would be real estate sales. Although the information is out there probably that anyone can get information on a piece of real estate that's for sale, the sale itself, the transaction doesn't occur in a public market. It occurs between you and if you're the buyer, you and that one seller. And you have real estate agents helping you out and collecting their 6% of the sale price. But that's a private market transaction. If you sell a car to somebody else, that's a private market transaction. It's between two parties, so the market itself isn't involved in that. So that's a way to distinguish those types of markets. So really, all of those ways, all of that sort of list of different types of markets, it's more of a way to describe a market really than identify a type of market. It's describing a quality of a market. Is it private? Is it public? Is it for a purchase right now or something that's going to happen in the future? Is it to be paid in less than a year or more than a year? And so these are sort of the questions that allow you to classify them in these different ways. So anybody have questions about any of those different types of markets? No? All right. Moving along. We're still in Chapter 2 here. The other thing Chapter 2 talks about is the different types of financial institutions. And I'm not going to list all of them, so you don't need to know all of them. But I am going to talk about what I think are the most important ones. The first is commercial banks. And a commercial bank is the bank that you and I go to have our checking and our savings account. So it's U.S. Bank, Bank of America, Chase, all those sorts of institutions. They're called depository institutions because they take people's deposits and put them someplace safe. And those deposits are guaranteed by the federal government up to a certain amount. And right now that amount is $250,000. So if you have less than $250,000 in your savings account or your checking account and the bank folds, then the government will give you the amount of money that you had in that account if the bank can't come up with it. And so they're called depository institutions. They provide personal banking services. They provide loans, car loans, home loans. That's really how a commercial bank makes their money, is by taking your money or taking the government's money and making loans at a higher interest rate. So right now, interest rates are really low. So if you put your money in a savings account, you're going to maybe earn 0.5%, which is nothing. It doesn't even keep up with inflation. The inflation rate is higher than that, and it's only about maybe 1.5% right now. So if you put your money in a savings account and leave it there for a year, you're actually losing 1% of the value, the purchasing power of that money by next year, because inflation is higher than the interest rate that you'd be earning there. But anyways, they will take your money at 0.5%, and then they will loan it back out in the form of a car loan, maybe at 3.9, 5.9, 10%. That's really dependent on your credit history. Or a home loan, which are also partially guaranteed by the government at, say, 4% or 5%. And the way the bank then makes their money is they loan money out at, let's say, 5%, but they get money from you at 0.5%. So the interest rate spread is 5 minus 0.5 is 4.5%. So that is their revenue for the bank from those loans. That's where their revenues, primary revenues, come from, is that it's called the interest rate spread, the difference between what they're getting the money at and what they're loaning it out at. That's how commercial banks make their money. And they serve both personal and business customers. So, and they loan to both people and businesses, obviously. So that's commercial banks. Investment banks, on the other hand, they don't issue checkings or savings accounts. The sole purpose, and I mentioned this briefly, of investment banks are to what they call underwrite stock and bond offerings. So they will put together all the legal paperwork and make the connections with investors to help a company sell stock on the public market. And to do that and to make their money, they take a cut of the value of those securities that they help the company sell. And typically it's 2 to 4%. So again, if Goldman Sachs helps IBM sell $100 million in new stock offerings, and their take is 3%, then they've just made $3 million to provide those services. So it can be very lucrative. Another type of financial institution are credit unions. So credit unions are like banks because they take people's deposits and they loan money out. But credit unions are member-owned, so they typically are not for profit. They're for the benefit of their members. So anyone who has an account with a credit union is technically part owner of that credit union or a member of that credit union. And so that's different than banks like Chase or Bank of America or U.S. Bank, because they are for-profit institutions. And so they're out to make a buck for their shareholders, because Bank of America and U.S. Bank and Chase, they sell shares themselves of the bank. And so they're out to make their shareholders money by being profitable. On the other hand, credit unions don't have that type of incentive because they don't sell shares. They simply have members that own the bank. And again, they're typically nonprofit. And so any excess revenues they have over expenses goes back to the members in some form, either in the form of maybe paying them slightly higher interest rates on their deposits, or maybe lower interest rates on the loans that they give out. The other, I'll just make this comment. That's not really a personal comment, it's just my observation. But credit unions will charge lower or don't charge fees for things that banks do. So if, for instance, you're a customer of, say, Bank of America, if you have an NSF check, if you write a check that bounces, they're going to charge you, I'm guessing, $35, maybe, somewhere in there. On the other hand, for a credit union, if you bounce a check, and at my credit union, I think they charge you $10 or $12, but you also have the opportunity to have your savings account and checking account linked at the credit union, so that if your checking account is low and you have some money in your savings, they'll just automatically move it over. They'll charge you $2 for that, but they'll automatically move it over and they won't bounce the check. Most of the time, banks won't be as likely to have features like that, because they honestly want to make some money from their fees, from those bounce check fees and ATM fees and things like that. So the fees at banks for those same types of services tend to be higher than credit unions. So that would be one reason that I would encourage any of you who have checking or savings account just to even look at whatever your local credit union is and look at the fees that they have and compare them to the bank that you're at right now. This could be a better deal. And the other thing, credit unions typically have, or they can have, lower loan rates for car loans or home loans or things like that than a commercial bank. So another good reason to have a pre-existing relationship with a credit union, because if you need a loan in the future and you have an account there, it's a lot easier for you to navigate that process with them. Okay. I mentioned mutual funds already, so that's another type of financial institution. I talked about that process, so I'm not going to go into that again. Insurance companies, this might be a surprise to some of you, insurance companies are actually a financial institution. So insurance companies, actually, here's a question. How do you think insurance companies make a profit? It's a pretty simple equation, but any ideas?
All the money you pay for your monthly and all the people not getting insurance, right? And all the fees.
Yeah, so that's how they make their revenue. The equation, though, the way that they sort of ensure that they're profitable is they have what are called actuaries, which are usually accountants or other mathematical wizards who crunch a bunch of numbers. They look at statistics, they look at data, and for instance, with car insurance, they will look at national data on who typically gets in accidents, their age, their sex, whether they're male or female, literally their marital status will impact some insurers' ratings for, or will impact some premiums for car insurance. So they'll look at a bunch of different factors and they'll determine on average how likely it is that you as a person, based on those factors, are likely to get in an accident, and thus how much it would cost them to pay off an insurance claim. And then they make their premiums slightly higher than that, or maybe significantly higher than that. And the difference between the amount they pay out and the amount they take in, that's their profit right there. And so that is how, and they do the same thing for life insurance. They, now it's fairly typical for a life insurance policy that they require you to get some sort of physical exam. And they'll take your blood pressure and they'll take your history. They'll want to know whether you smoke or not. They'll take weight, body mass index, all this sort of stuff. And then they have tables that the actuaries have created that said, this is how likely this person is to live this long. And therefore, this is the likelihood that we would have to pay off a life insurance claim. And they base their premiums off of that. So they're making more money on average over the long term than they're paying out. It's sort of like, honestly, it's sort of like the casino. So the casino games are engineered to pay off at a certain percentage, right? And it's over the long term, so you'd have to play forever to hit that exact percentage. But they can say over a long enough period of time that the casino will make 3 or 4 or 5% on this machine, if we're just talking about slots here. So you may get a payout in the short term, but in the long run, if you kept playing that thing forever, you would lose 3 or 4% of your money. That's how it's sort of engineered. So the casino accepts these little blips, these payouts that they have to do, knowing that over the long term, it's going to just mean that they make money at whatever rate it is. And that's typically limited with a state compact, but I'm not going to get into that. So that's insurance companies. That's how they make money.
Actuaries, that's what those research people are called?
Yeah, actuaries is the name of the people who crunch the numbers and look at demographic information, and literally they take Social Security death information on all the people who have died and look at that data, and they gather this data from a number of different sources, and then they will calculate a rate, and they create the table essentially that the insurance companies use. Yeah.
They do pretty well. I mean, that's for occupation.
As far as pay?
Yeah.
Oh yeah. Actuaries, yeah. If you, I don't know how interesting it would be to sit around cranking numbers all day, but yeah, I think they do pretty well. They make pretty good money. So, like I said, I think most actuaries are either accountants or mathematicians, because that's typically what they're doing, is doing a lot of statistical calculations. All right. So the last type of financial institution I just wanted to mention are pension funds. And so pensions aren't that typical anymore. There used to be companies offered pensions more frequently, but there are still some pension funds out there. And a pension is essentially, it's a retirement plan that typically guarantees a benefit every month, let's say. So if you worked at IBM for 30 years, then you would vest into this pension plan that says every month from when I retire until I die, you're going to pay me $1,500 a month or something like that. So it's a guaranteed benefit plan is what a pension plan is. Most organizations these days don't do pension plans because there's a lot of risk in that, especially if people are living longer and longer lives. They're going to have to pay out more and more and more. So there's a really high level of uncertainty for pension plans as far as how much money they need to keep in reserve so they pay this out in the future. So most companies now offer a retirement plan where the company may kick in some money, but you also kick in money and you build up this retirement amount. And that, in the end, that's what you get. You don't get a payout for the rest of your life. But there are some pension. Oh, go ahead.
Can pension plans be dangerous too at the same time? Because didn't Enron, who also controlled PG&E back in the day, convinced all their employees to invest their pension plans into Enron, hoping they'd make more money in the back end? But then Enron went down and no more pension plans.
Right. So the employees lost all their stock in Enron because Enron stock became worthless. However, the government actually has an insurance fund for pension funds that if the guarantor of a pension fund or the entity that's supposed to pay out the pension goes broke, then the federal government has to kick in money. And there's actually been a lot of uncertainty whether or not the government has significant reserves to really pay out significant pension benefits if a big pension fund goes down. So there are some guarantees, and I don't know all the specifics, but there is a government backstop to if a company goes down who's offering a pension, goes out of business, then those pensioners will still get money. But anyone who owns stock or bonds in Enron directly, there's no insurance for that. They simply lost their money.
Yeah, they lost it all.
Yeah. So if it was part of a 401k plan where they had all their stock in Enron in their 401k or their IRA, then they lost that. Yeah. So that's a little bit different than a pension fund. But, yeah. All right. And the reason I bring up pension funds is because these funds are very large. Literally, they have billions of dollars in management that they have to manage and plan to pay out these pensions for 10, 20, 30, 40 years into the future. And so the investment advisors or the investment manager's job is pretty difficult because they have to try to estimate how much the pensions are going to cost them, and then they have to put together an investment portfolio that's going to allow them to build up the money that they need to have to be able to pay out those pension payments in the future. So there's a lot of uncertainty both on the investment end, but also on like how much are they going to have their liability, their pension liability, what they need to pay out in the future. So, but there are still some big ones around, and they can have an impact. They're considered an institutional investor, which just means that they're a business that invests significant funds, and therefore they can have big stock positions in companies, and companies usually listen to them, because if you own 100,000 shares of a company or 5% of a company, they're pretty likely to listen to that one shareholder, because if they don't, they may sell their shares, and then their share price will likely go down. So okay, so there are a few other financial institutions that they talk about in Chapter 2, but those are the main ones I wanted to cover. Any questions about any of those financial institutions? Okay, so one other thing we'll talk about, and then we'll take a break. Or I'll talk about. And again, I apologize for sort of spewing information tonight, but I wanted to get through a lot. So, stock markets I've mentioned already. So there are, if you want to classify stock markets, one way you can do it is whether they're a physical exchange or an electronic exchange. So stock markets like the New York Stock Exchange, there's actually a stock exchange in New York where traders go in there, they ring a bell, they throw pieces of paper around, they yell at each other to buy and sell stocks. That's a physical market or a physical stock exchange. The same with the Chicago Board of Trade, which is it's a commodity exchange in Chicago. It's probably the main location, the main market for commodities in the United States, where they trade corn and pork bellies and oil and all these other things, these commodities. But those are physical marketplaces. Over the last 20 years, there's developed electronic exchanges, essentially, or what they call OTC, over-the-counter markets. And so one example of that, the biggest one in the United States, is called NASDAQ. It's an abbreviation, and don't ask me what it stands for, but it's NASDAQ. It's actually the National Association of Securities Dealers and something. I don't know what the AQ stands for, but and so that market is all through computers. There's not one central physical location where that market takes place. There's just literally a network of computers throughout the country that you can trade stocks electronically back and forth on. And so big companies like Merrill Lynch or Vanguard or any of these big stock investment companies will have a terminal, and they will literally be trading away electronically back and forth.
Isn't it called high frequency trading or something like that?
That's a type of trading
Okay.
that does involve computers, and so high frequency trading essentially is you have a computer that's trading for you, and that computer, you've fed in a bunch of algorithms and information that says if the stock market does this, then you buy this or you sell this. And so you'll have computers that will be being fed this market information, and based on that information, they will decide to buy or sell. And high frequency trading, literally they're trying to make money off of the changes in a stock price that's less than, say, a cent. Like when things fluctuate in really small terms, if they trade enough of those shares, they can make money even if it's a half a cent per share. And so that's what they have programmed computers to do. In some cases, there are still humans who trade. And I don't know what the proportion of human to computer trading is, but there is a lot of concern, actually, that the more and more we have computers trade, the more volatile the markets will get. In other words, the more up and down significant spikes that they'll get, because if you have a few thousand computers that are trading off the same program essentially, and they all see the same data, then they're all going to try to sell at the same time, or they're all going to try to buy at the same time. And so, the Securities and Exchange Commission, the SEC, which regulates the public stock markets in the United States, has really looked into that and is putting together, and it has put together some regulations that try to limit that. And in fact, sometimes in some markets around the world, they'll have what's called they will essentially shut down the stock exchange if it drops a certain percent. So if a stock exchange, if the entire exchange drops 10%, they'll close down trading, and you won't be able to trade anymore. And they'll usually shut it down until the next day or maybe a few days out, just to allow things to settle down. But it happens more and more now that you have more computers literally trading for companies. So over-the-counter electronic exchanges, NASDAQ, physical exchanges, or the NYSE, the New York Stock Exchange, or Chicago Board of Trade. Two types. Okay, it's 6:01. I need a break from talking, so why don't we take 10 minutes and take a break, get up, move around, get the blood flowing, and we'll come back and have a little bit more in Chapter 2, and then we'll launch into Chapter 3. Let's see.
Yeah, that was an interesting part of the chapter there, the CDO thing.
Yeah.
I watched that movie, The Big Short, about the financial collapse.
Oh yeah, how was it?
It was good.
Yeah.
I mean, it's about all the stuff that they kept it like.
Where did you see it?
At the, we call it Mark Leibovich.
Oh really? It's playing there?
Yeah. It
Oh,
was
okay.
I don't know if it still is.
Okay. Yeah, I hadn't seen that it was there. I want to see that.
There's a lot of movies like kind of fluctuating around in that theater.
Yeah, well, it seemed like they only had Concussion in there for less than a week or something, and then it was.
Yeah, that was a good movie too.
Yeah.
I saw that.
Oh, I want to see that. Yeah.
But yeah, that was a part of the big thing was the CDO thing.
Uh-huh.
It was like because through that movie they try to explain it.
Mm-hmm.
Like they'll take a moment in the movie to try to
Right.
break down what all these terms are. Yeah, they kept it pretty interesting.
Huh. So did they do a pretty good job of explaining the topic?
Yeah, for the most part.
Yeah.
They get like these other television personalities. Like here's Anthony Bourdain to explain what a
Oh, really?
CEO is. Or something like that.
Oh, God, I can just imagine Anthony explaining this,
Yeah.
especially after he had some drinks. I'm sure.
Yeah, exactly.
Good old Anthony. Huh. Cool. I'll have to see if it's there. Yeah, I'd like to see that movie.
Yeah, it was a good one.
I think it's interesting. I think that when they tackle some of these really complex subjects in that medium, in a movie medium, they can do a pretty good job at breaking down a very complex subject into.
It's too bad because I think the fact that it deals with this, like a lot of people see, oh, it's about finance,
Right.
or whatever you want to kind of turn off. But
Right.
it has a lot of big actors and stuff in it, so
Huh.
That's enough for them to tune into it.
Yeah. All righty. Let's get back going here. So what I want to do now, just to sort of finish off material from chapter 2, is to read. Paul and I were just talking about this, but there's a reading on page 38 if you have your book, or if you don't, under week number 3, there's a link under resources called Chapter 2 CDO reading. So it's just a one-pager. But I'd like everybody to read through that. So we'll take about, 5 or 6 minutes.
What page is it?
It's page 38 in your book. And it's called Securitization. The title at the top is Securitization Has Dramatically Transformed the Banking Industry. So it has some pretty complex topics in it. So I just want give everybody a chance to read through it, and then we'll talk about it a little bit, or I'll explain some of those topics. So take about 5 or 6 minutes and read that.
What page did you say that was again?
It's page 38.
Okay, thank you.
Mhm. Okay, I'm just gonna you haven't finished reading that. It's not the lightest piece of reading in the world, but it is, I think, an important concept to explain in the context of finance world, because this is how a lot of banks did operate in the mid 2000s, maybe a little bit less so now, but it still happens. So the process of these CDOs are collateralized debt obligations. So essentially they're, you can think of them as a bond, and people invested in these. Actually, usually not people, usually financial institutions, banks. Other banks bought a lot of CDOs from different banks. Merrill Lynch, Lehman Brothers is an investment, was an investment company that no longer exists, who bought a bunch of these in the mid 2000s. And essentially what a CDO is a group of, let's say, 1,000 different home loans. And so Washington Mutual, which is also no longer around, partly because of these, would work with an investment bank, and the investment bank would put together 1,000 different home loans that paid a number of different interest rates, 3 to 5 to 6%, whatever, based on the risk level of the person holding the loan. And they put it together in a security, these 1,000 home loans, and then they sold it to other investors with the expectation, the investor had the expectation that they would earn an average amount based on those home loans, the returns from those loans. And so this allowed the banks who were selling these loans to essentially make more loans. And so they weren't going to be making interest for the next 30 years on these loans. They would just take sort of a one-time cut and sell the rest to investors, and then they could free up more of their own money to make more loans to more people. And so it sort of created this cycle for banks of wanting to make more and more loans, because they were creating these securities and then they were selling them off. People were buying them and said, okay, I want to make more loans. And so what happened in the one of the reasons in the between 2000, started in the early 2000s and sort of ended in 2007, 2008, banks' lending standards started to go downhill because they wanted to make more and more loans. And to do so, they had to decrease their lending standards. They required less documentation. And so all of these loans with less documentation, less screening, higher risk individuals who were seeking home loans went into these securities and then were sold away. But what started to happen is that investors, some of these loans started to fail. The economy didn't do so well. The subprime loans were the loans that, for people who would maybe get interest-only loans, or people who had bad credit but were issued a loan anyways, or people who reported income but didn't provide proof of their income, and therefore it was sort of made-up income. The banks weren't requiring like W-2 forms and pay stubs and things like that, like they do now, to document and to assure that they had the income to support these loans. So some of these loans started going bad that were in these CDOs. And so all of a sudden, you had parts of the CDO falling apart because you had these loans that were going back to the bank, or were going back to the lender because the person who got the loan couldn't make the payment. And so the returns on these investments started going down, and there became a lot of questions about how reliable were these particular types of investments, because they had 1,000 different loans in there, and the people who bought them didn't look at each of those loans and determine how risky those loans were. They just made an assumption based off of what an investment banker in many cases told them, or a ratings agency like Standard & Poor's, which didn't do a great job of looking into the risks involved in these. And so what happened in 2008 is all of a sudden there were all these CDOs out on the market that people owned, and then all of a sudden everybody wanted to sell them at the same time because nobody wanted that risk, because they were finding out how much more risky they were than they thought when they originally purchase them. And so what that did is all of a sudden banks didn't have resources to loan money anymore because no one would buy these securities from them anymore. And so they would have to hold the loans themselves, and they didn't have the resources to do that. So that's what happened to cause the financial crisis in 2007, 2008, is that all of a sudden banks didn't want to lend anymore. And so credit shrunk up, interest rates went up. Some businesses who relied on short-term credit just to function couldn't function anymore because they couldn't get short-term credit from banks anymore. And so it caused a lot of problems, and that's what caused really one of the causes of the Great Recession, as they're now calling it, of 2008. But this is an example of what investment banks do. They take different securities maybe, and they put them together in a package, and then they try to sell it to investors. And there were a number of breakdowns in this process, from the bank screening of the loan applicants to the rating agencies doing their job and saying, well, this is how risky of an investment this particular investment is. They really weren't doing a great job at identifying risk. And so the whole thing sort of blew up at the same time, and the CDO market went way down, and banks didn't want to loan out money, and it caused all sorts of issues, which caused the Great Recession. So, and caused certain businesses like Washington Mutual and Lehman Brothers and a few others who were not bailed out by the federal government to go out of business or to be bought out at a very low price by some of their competitors. So this is one of the potential negative aspects of securitizing different stocks or different securities and then selling them out, is that there's a level of uncertainty. If you have a bunch of things in this one security, it's hard to measure what that average risk is if you have 1,000 different things within one particular security. And so if the rating agencies aren't doing their job really well, then no one can really know what the risk level is in those securities.
There really isn't so much the CDO of being a problem, it was kind of the mismanagement of
Yeah. The way the CDOs, what was securitized in the CDOs was the problem, the loans, because of the way the loans were made, and that due diligence wasn't done by the banks in the first place. So then the loans started failing, and and the rating agencies who should have looked into those individual loans or done some significant research and identified those risks didn't. Yeah. So it was really a number of different processes that just didn't work.
Became a domino effect.
Yeah. And it caused.
Like it was easy money, and people just kept watching the money come in, and all of a sudden it didn't come anymore, and then it just. Because my mom was a realtor, and she knew some lenders, and I know my mom was part of the reason why this whole thing happened. They would give loans to anybody.
Yeah.
People that you got Social Security cards from a back of a Burger King, those types of people.
Yeah.
And I was wondering like why it didn't happen a long time ago, but
Yeah.
Yeah.
Well, yeah, and so there were a lot of incentives that sort of caused this to happen on a big scale too. So mortgage brokers who are still around, they make their money by essentially making loans, and so the more loans they make, the more money they make. So that's a sort of a disincentive to really clearly screen your applicants, because you just want to push as many, if all you're concerned about is money, you just want to push as many people through the loan mill as you can get, because that's how you increase your income. To some degree, same with realtors. Realtors just want to sell houses. I won't say just want to sell houses, but that's how they make their money, by selling houses, and they get 3 to 6% of the commission of the sales of a house. And so the more houses they sell, the more money they make. And one of the other issues was that there were some real conflicts of interest, and they put some barriers in now, but like the appraisers. So the appraiser is supposed to come in, and they don't represent the buyer, and they don't represent the real estate agent. They're supposed to really represent the interest of the bank or whoever's making the loan, to determine whether or not the house is really worth what it's worth. And a lot of times what was happening in the early 2000s, mid 2000s, was that real estate agents were getting really cozy relationships, and lenders were getting really cozy relationships with specific appraisers. And they all had this interest in making sure that the loan went through and that they sold the house, and because that's how they get paid. And so appraisers' standards maybe decreased. They didn't have an incentive to do a really great job because they just wanted to push this thing through the system. And so that the real estate agent and the bank and the mortgage broker, they all made their money. And if those entities knew that an appraiser was a little easy and would give them the numbers they needed to make the loan work, then they would probably use that appraiser more, and that appraiser would make more money. So there's a lot of conflicts of interest. Right now, lenders cannot contact appraisers directly. There's been a firewall put in place now.
There was a Red Rock Country Club. I'm from Las Vegas, and there were some houses, there's people literally getting their house appraised, and as it was done before it was even built. So they'd get a high appraisal rate on land that wasn't even built yet, get a huge check, and then they max out their lot.
Yeah.
What the heck?
Yep. Yeah, Las Vegas, Nevada and Arizona got hit the biggest as far as that real estate bubble bursting, and their markets are still recovering. Ours up here recovered fairly well, and we didn't get hit as hard with real estate prices just crashing when loans became hard to get. But Arizona, parts of Arizona and Nevada just suffered dramatically, and are probably still suffering.
Yeah, if you go to this place called Lake Las Vegas, $1 million homes everywhere. They even dug out their own lake in between. So it's nobody's living there. They even have a whole casino that was in the middle of the thing that abandoned because nobody was going to it.
Wow. Yeah. Yeah. So, all right. So any questions about that reading or the CDO or any concepts? Anything I just mentioned there?
What's their classes like?
The classes. So one of the things, they're called tranches, and there's actually a winery that has tranche in its name because somebody made a ton of money off of, an investment banker made a ton of money off of creating these CDOs. They named the winery. Yeah, it has tranche in its name. But a tranche is, so when people bought these securities, they had different classes of investors, A, Bs, and Cs. And it sort of, it relates to the risk value. So the A investor had the lowest risk and the lowest return, so they get paid the least. The B investor had a moderate rate of risk and a moderate return, and the C investor had the highest risk but also the highest return. And so what started happening when these individual loans failed and these CDOs their returns started going down, the C investors suffered heavily. The C investor would lose their investment prior to the B investor. The B investor would lose their investment prior to the A investor. And so it became anybody who bought these CDOs as a Class C or a Class B investor, when the market took a dive, they lost literally all of their investment. I won't say Class B, but Class C in most cases lost all of their investment. So it was a much higher risk to do that with it, and they were anticipating that they'd get this greater interest rate return. But when they started failing, they were the first ones to lose their investment.
How do you know if you're going to choose a Class A, Class B, or Class C? Is it depending on how much you're going to pay?
No, they will sell them. You will make the selection as the investor. You will say, I want to buy Class B or Class A, and they will charge you. There will be different prices for those different tranches. Yeah. Mm-hmm. Okay. All right. So that's pretty much what I wanted to cover in Chapter 2. And really what I want to get through in Chapter 3 tonight is just, I'm really hoping this is a review for you of the different types of financial statements and what you should expect to see in them. The main reason I want to get through these is because one of your assignments that I'll be doing next class requires you to essentially use a financial statement to figure out an answer to a question. And so, so I want to get through these descriptions, and then I'll talk a little bit about that assignment. It's a Chapter 3 assignment. It's the first assignment probably that you'll be doing. It's not hard calculations, but it's math, and you'll have to think through the equations. And so you really want to understand these financial statements so that you can then do that. And in fact, and hopefully I'll say this at the end, but to do the Chapter 3 assignments, in most cases, you will want to create one of the financial statements for each of those exercises. So if it's an exercise about the income statement and they give you some information that goes into an income statement, just create an income statement, plug in the numbers, and then you'll figure out the answer from there. It's really hard to visualize without actually creating a financial statement for these particular problems. So, all right, so let me, I'm going to go to Chapter 3. I'm going to open this up on my computer and then share it out. There's a resources, Chapter 3, readings and figures. And if you have your book, this is all in Chapter 3. But I'm just we're gonna go through these different financial statements. And so let me start. We'll start with the balance sheet. And this is a description. Let's see, where's the... There's the balance sheet. This is sort of a good graphic description. Oh, wait, let me share my screen. This is a nice little summary of what you can find on a balance sheet. And so first of all, on a balance sheet, is a balance sheet represent a period of time or a set point in time? Does it cover like a year, or is it just valid for a day?
Just snapshot, right?
Yes, it's a snapshot. It's one point in time. So if I ran a balance sheet for the college right now and I ran a balance sheet for the college tomorrow at 5 p.m., it would be different because every accounting transaction that goes into and changes an asset or changes a liability is going to change the balance sheet. So it's just a snapshot at one point in time. Typically, they will do a balance sheet on the last day of the fiscal year. So if your fiscal year is the calendar year that ends on December 31st, then they would include a balance sheet for December 31st, and that's what the status of the company would be on that day. The main components of the balance sheet are assets, liabilities, and equity. And they typically classify in a classified balance sheet. They will split out the assets based on current assets or long-term assets, or sometimes they call them fixed assets for long-term assets. Another term that you might run into is property, plant, and equipment. Those are also long-term assets. So current assets are anything that you can turn into cash in less than a year. So cash is a current asset. Accounts receivable, things that people owe you that you expect them to pay, is typically due in less than a year. Your inventory, if you're selling an item, you typically would expect to sell that inventory in less than a year. So those are all current assets. Then you would have your long-term assets, and this is typically real estate, property, buildings, vehicles, equipment. Let's see, what else am I thinking of? Tools. We actually, on the colleges, this is probably fairly unique in most of the world, but on the colleges' long-term assets, we have 2 or 3 totems, because we have these totem poles that have a useful life of, hopefully they're going to be there for 10, 15, 20 years. And so we list them on our fixed asset list, along with cars and buildings and all these other things. So
How'd you get a value? Is it how much that you charge the carver?
Yeah, well, it's how much the carver charged us. So it's the amount we paid for it is the original value. Is what we.
Okay, cool. That's pretty unique.
Yeah, yeah. yeah, when the auditor was here this year, one of the things they'll do is they'll walk around and they'll want to look at different assets. And so he wanted to see this particular totem pole, and it took us a while to find it, and we finally found it. It wasn't actually installed yet. It was over in the Coast Salish Institute, in storage out front there, and it was waiting to be installed. So we had to identify which totem pole it was and then find it. So it was interesting. So there are assets, and then there are liabilities. And liabilities are just things that the company owes, and so things like accounts payable. If the college buys something from Office Depot on credit and they send us a bill next month, that's accounts payable. We owe them money. Notes payable are short-term loans, and again, current liabilities are things that are due to be paid in less than a year, and long-term liabilities or long-term debt is due further out than a year. And so current liabilities, notes payable is a loan, some sort of loan that's due in less than a year. Accrued wages and taxes, if you remember from financial accounting, you need to, well, especially at year end, you need to sort of estimate how the amount of wages that are owed to employees who have already performed work but not been paid. Those are accrued wages. There's something that you owe but have yet to pay. We'll probably pay next week, let's say. And so those are accrued wages, and that's a current liability that you have to pay. And then long-term debt is like funding for a building. If you have a 30-year loan on something, or even a 2-year loan is considered long-term debt because it's greater than a year. One of the things we may run into, depending on the balance sheets that we look at this quarter, is if I have a 30-year loan on a house, some of that's going to be long-term debt, and some of it's going to be here under current liabilities, notes payable. And the portion that'll be under current liabilities is like the next 12 months worth of payments that I owe on that house. That will be considered a current liability. Everything past that, let's say months 13 through 360, if it's a 30-year loan, would be considered long-term debt. And so you'd actually split that loan into two pieces, and one would be contained in current liabilities and the other would be in long-term debt. So, and then the last part, and I don't know who you took accounting from or how accounting is being taught right now. When I taught accounting, we didn't talk too much about stockholders' equity. We identified it in a more basic term of owner's equity, so assuming it was like a private owner of a company. It's the same thing. The equation is the same: assets plus liability, or assets equals liabilities plus owner's equity. But here, stockholders' equity is the equivalent of if it's a publicly owned company. So if they have stock, like now Facebook, Microsoft, whoever, that's contained here. But the amount of stockholders' equity is, and this is something you want to keep in mind for your assignment in Chapter 3, you calculate that by taking the value of the common stock and adding the retained earnings. So you have to put both of those things together, and then that will give you the total stockholders' equity, what the stockholders have in the company. The stock is what it's worth, but then the company also has, they have buildings and cash and other things that aren't included in that common stock. And so if the company were to completely sell out and liquidate and distribute everything to its stockholders, then it would be the price of the stock plus retained earnings, which is essentially all of those extra things, the cash and things that the company maintains to operate. So those are the components of the balance sheet, and this is, of course, what a balance sheet looks like. They provide 2 years here, 2011 and 2010, and like I said, they break this down from current assets to net fixed assets to current liabilities to, they don't call it long-term debt, but they call it long-term bonds. That's essentially their long-term debt entry right there. And then the stockholders' equity is down here, which is the common stock plus the retained earnings, and that gives you the total common equity there. So that's the balance sheet. Need to understand how that goes together, and again, it's a snapshot in time, typically the last day of the fiscal year. Any questions about that balance sheet? No? Okay. Let's move on to what's next? The income statement, I hope. No, not that. Yes, the income statement. I usually have this in a slide that just has the figures, but I couldn't find my scan file, so I'm just using this. So the income statement is maybe the most important financial statement for most companies, certainly most for-profit companies. And so the income statement is, as opposed to a snapshot, it's for a period of time. So you could do an income statement for a week, a month, a year, 2 years, 3 years, but it's from a start date to an end date. And this is a very simple one here. A classified income statement, you'll often see things broken down into cost of goods sold and general and administrative expenses. You might have different types of expenses. You might have taxes. You might have depreciation expense. But this is a fairly basic version. We're going to get more in depth in the next 2 to 3 weeks. But so the most basic part of the income statement and the most important part to understand starts with revenues. Revenues are sales. It's the money that you take in minus expenses. And so, and in this case, they're just calling it operating costs, expenses. And so you have your sales here, total sales of 3, and this is in, you always want to read in the title how they're defining these numbers, because this company didn't sell $3,000 worth of products. This company sold $3 billion, because this is in millions. So this is 3,000 millions, which is $3 billion of net sales. And then they have this operating cost, except depreciation and amortization. And then they have depreciation and amortization. So these two numbers right here are subtracted from 3,000 to give you this number. Or excuse me, that number is the total operating cost. And then you subtract 2716 from 3,000, and that gives you your operating income. We're going to be talking about operating income versus net income and doing some calculations off of these. So you want to, I want you to be aware of the difference. So operating income gets you this $283.8 million. But this is income before you take out interest and before you pay your taxes. So if they have loans, there's going to be interest expense that goes along with those loans. And so then they will say less interest. They will subtract 88 million from that sum, and that gets them down to their earnings before taxes, EBT. This number up here is called EBIT. We're going to be using these acronyms too. EBIT, earning before interest and taxes. EBT, earning before taxes. So earning before taxes is 195.8. Taxes are 40%. Not that corporations in the U.S. pay 40%, but that's what it's at. All sorts of different tax breaks. So if they were to pay a full 40%, they would pay $78.3 million in taxes. Subtract that from your EBT, and that brings you to your net income of $117.5 million. So in the end, that's what this Allied Food Products company made after selling $3 billion worth of goods in the year. So one of the things that you probably didn't talk about or look at in financial accounting with regards to income statements was how this 117.5 gets divvied up, where it goes. And in the most basic cents, it goes to one of two places. Maybe one place, maybe two places. It could go to dividends, and a dividend is a payment to a stockholder. So if you own a share of stock and the company makes money and they decide they want to pay money to their stockholders, their owners, they'll pay out a certain amount per share. So if you own 10 shares of stock and a company says, we're going to issue $1 per share dividend, then you would get a check for $10 basically as a shareholder, $1 per share that you own. So some companies distribute dividends on a regular basis. Other companies, and these are typically companies that have been around for a while and are making a good amount of money and aren't trying to grow and expand all over the place. So they'll distribute some of their money to the shareholders, which makes their shares more attractive because shareholders can expect a little bit extra. But they will also retain some money for the operations of the business, to expand, maybe to purchase. It depends on the plans of the managers of the company, but they may want to keep some of those profits in the company to buy new buildings, new equipment, to do whatever. And those are considered retained earnings. So retained earnings, the way you calculate that is just by taking your net income and subtracting out any dividends that have been paid out. And the remaining amount that you retain, that the company retains, is called retained earnings. So in this case, it would be $60 million because they distributed 57.5 and this was their original amount that they made in net income. Okay. So that's how net income gets distributed in a public company, either to dividends or retained earnings or both. Okay. I'm not going to go into right now these per share data. We're not going to be working too much with this unless we have extra time at the end of the quarter, but we're going to be concentrating more on the financial aspects of the total company or the total organization versus this per share data here. So any questions about this income statement or where these numbers are coming from or anything like that? I'm really hoping this is a review for the most part. I know you may have taken financial accounting a year or more ago, but we hope that this information sticks with you for a little while on this. Okay.
And all this stuff would be in the accounting book, right?
Yes. Yeah. So if you still have your accounting book, look back at that and use it maybe in conjunction with these so you can compare and contrast how they're the similarities and the differences.
Would it be the first accounting, like the financial accounting, or the managerial accounting?
Well, managerial accounting has some of that, but you should have been introduced to the financial statements in financial accounting. So
yep, I remember all this stuff.
Well, okay, good. All right. So there are no other questions. Let's see if there's anything else. So one of the financial statements that is probably the most complex is the statement of cash flows. And this is on, if you have your book, this is table 3.3. But the statement of cash flows, just like an income statement, it represents a period of time. So it has a start date and an end date. Typically, it's for the fiscal year. So from the first day of the fiscal year to the last day of the fiscal year. And what the cash flow statement will tell you is during the course of the year, based on all these different activities that are listed here, they have them grouped into operating activities, long-term investing activities, financing activities. There are 3 groups. Based on all of those different things that the company did throughout the year, did they have more cash or less cash at the end of the year than they had at the start? And so I'll go through some of these. One of the things I really encourage you to do with this particular figure, though, is all these letters next to these lines, there's a note. You can go down on this page and the page after it, and it describes what that represents and whether or not a particular activity will have a positive impact, will increase cash flow, or a negative impact will decrease cash flow. So I'll go through a few of these, but I really encourage you, and this is another one that there is a question in Chapter 3 assignment that will require you to figure something out based on a cash flow statement. So you really need to, I would recommend, construct a cash flow statement based on the information they give you in the problem from Chapter 3, and then you'll be able to figure out the answer. But I encourage you to do that for all the problems in Chapter 3. It makes it a lot easier to figure out and understand, and I think it's just a great learning tool to have you create these financial statements. So here, I'll just go through these 3 groupings here. We have operating activities, and so that's where your net income comes in. Because you made money during the year, that's positive. That's 117.5 positive. You have depreciation and amortization. So depreciation is essentially you have these assets and they slowly lose their useful value. And so every year, say with a car, if it has a 5-year useful life, every year in your income statement, you take 1/5 of the value of that car and you call it depreciation expense, and it goes away. It's not that you're actually paying out that money, but you're sort of losing the use, or that asset is becoming less valuable. And so you take, you measure that in the income statement and with depreciation expense. And so any depreciation expense that you recognize will actually have a positive impact on cash flow, because your income statement will show it as an expense, and so they'll take away from your revenues. But you won't actually, from a cash sense, be paying anything out. And so it's actually has a positive impact when you have depreciation expense on your cash flow statement. These other things, increase in inventories. So if you have more inventories than you did the year before, then that technically will take away cash from your, actually, I need to check that because some of these, okay, increased inventories, yeah, so in this case, they increased their inventories, which meant they had to pay for those inventories, and they increased them by 200 million from the year before. And so that had a negative cash impact of 200 million. This is assuming they paid for them all during the year, but they're keeping it fairly basic for us here. If accounts receivable increases, that means we didn't actually collect as much money. We sold items and we recognized the revenue, but we didn't collect it all. So that actually has, when AR, accounts receivable, goes up, that decreases your cash flow by that amount. If there's an increase in accounts payable, in other words, if you owe more at the end of this fiscal year than you did at the end of the previous one, that's actually a positive impact because you bought something but you haven't paid for it yet. So if your accounts payable goes up, that actually has a positive impact on your cash flow, because it doesn't mean that you're not going to have to pay it, but it at least means in this year you didn't pay it, and therefore you have more cash because of that. And accrued wages is sort of the same thing. If you increase your accrued wages, it means you owe wages, but you have yet to pay them, and you have $10 million more in accrued wages than you did the previous year, so you've saved $10 million. It has a positive impact on your cash flow. So you add all of these numbers up, and you get down here, and this last one is net cash provided by operating activities. So you basically summed all these things up, and it comes up with negative 2.5. That means if we just consider these things right here, the impact on our cash position is negative $2.5 million. We would have $2.5 million less this year than last. Long-term investing activities. So this is when you buy property, plant, and equipment. And in this case, if you add to that, if you add to your property, plant, and equipment, that takes money, so that actually decreases your cash flow. This is with the assumption that you're purchasing with cash. And if you don't, then we take account for that in the next section here in the financing. But they have more property, plant, and equipment $230 million more than they did at the beginning of the year. Therefore, that's a negative $230 million impact on their cash flow. And financing activities, this last group, so this has to do with how much money they have access to via loans or bonds. So in this case, if they increase the amount that they owe on short-term loans, or what we call notes, our short-term loans, they have $50 million more in loans than they did last year. That means they have $50 million more than they did last year. If they have more bonds outstanding, that means that they have gotten people to buy more bonds and give them more money for bonds. And so they have $170 million more in bonds this year. But if they pay out dividends to stockholders, that's a negative. And we saw in that income statement that they paid $57.5 million out in dividends to stockholders. So that's a negative impact on cash flow. And so again, you sum these three things up and you get a positive $162.5 million. That's just from financing activities. And then the last step in this cash flow statement, the summary, in step R, you basically take the totals from sections 1, 2, and 3, negative 2.5, negative 230, and positive 162.5, and you add them all up, you get negative 70. That means that at the end of this fiscal year, you have $70 million less in cash than you had at the beginning of the fiscal year. That's the cash flow during the year. You have 70 million less. And to figure out what technically you have in cash right now, though, you started the year here, beginning of the year, with 80 million in cash equivalents. And you subtract 70, and that leaves you with 10. So now you have $10 million in cash at the end of the year, cash equivalents. So that shows your cash position. This is not a positive cash flow statement for this company. This means that they essentially, they're not very liquid. They don't have many resources right now to pay bills if they only have $10 million. And it went down from 80 million at the beginning of the year to 10 million at the end. That's typically not a good sign at all. So, okay. I know we reached our limit here. So, again, I would look through this. I went through this really quickly, especially this cash flow statement. But look through the cash flow statement, read these notes below so that you understand what happens based on these activities. Because part of the one of the problems in Chapter 3 is going to tell you the activities, and then you have to determine whether or not that was a positive or a negative impact on cash flow. Okay. All right, so we got a few announcements, then I'll let you go. So the first big announcement is I'm really hoping that some of you are sad about this. It would make me feel really good. We're not going to have class next week. I'm going to be out of town in New York for a conference for 4 days. So although I might be able to do class from New York, I don't want to promise it and then not be able to deliver. So I'm just saying we're not going to have class next Tuesday. So, but under week 3 on Canvas, there are several things that I'm going to ask you to do before then. One, there's a discussion question about what investment would you choose. So if you click on that, and it's listed under the, I guess I can go over there since I'm still sharing my screen. Yeah, is what investment would you choose here? So if you click on that, it asks you a question, and it says, please describe your investment choice in 2 to 3 paragraphs and explain your reason. So that's one assignment for February 9th is the next time we'll meet, 2 weeks from today. The other, which I will provide you information, it's not available yet. I talked about the Native Nations Institute module that we'll be using in this class, the Native-Owned Enterprises. They're in the process of registering this class so that you can then sign up for that and start using it. They haven't done it yet. As soon as they do that, I will send the information to you. And what I'd like you to do, and I'll reiterate this in an email to you, I'd like you to register, start working with it, and work up to quiz 2. There are 4 quizzes in each module, and so quiz 2 is essentially the halfway point. If you haven't used these modules before, I would anticipate that you would spend 3 to 4 hours making it to quiz 2. So it's not a short thing. It's probably about 20, 21 slides that you'll be going through and having quizzes. So that's the second assignment. Third, and so then there are chapter 2 and chapter 3 assignments. This is where I was telling you that there are questions and there are problems at the end of chapters. Questions, chapter 2 is questions, 2:1 through 2:4 and 2:8. Chapter 3 is problems. So make sure you're doing the problems 3:3, 3:4, 3:7, and 3:10. Questions, you'll be providing more information. Problems, you'll be calculating things. And so those are the ones that I really encourage you, these problems, to create whatever financial statement they're using, whether it's a balance sheet, an income statement, or a cash flow statement, based on the information they give you, and that will help you find the answer to the question that they then ask. And then the other thing is to read chapter 4 for 2 weeks from now, for February 9th. Chapter 4, we're going to start getting into calculating ratios based on information in financial statements. So that's another good reason why you really need to be familiar and comfortable working with financial statements. So, okay, any questions?
No.
No? All right. If you do have questions, I will be available via email. I can schedule Zoom meetings if you want to meet with me via Zoom. Even if I'm in New York, I can probably make time to do it. So just contact me, email me, and let me know. Email will be the best way to reach me these next 2 weeks, and we can set something up. And if you have any questions, you can email me also. So. All right, if there are no other questions, thanks for putting up with me talking for 2 hours, and have a good couple weeks, and I will see you back on February the 9th.
Awesome. Travel safe.
Thanks. I'm hoping the snow is melted by next week.
Oh, that's right.
Yeah.
Oh, I know. They had a bad storm, huh?
Yeah, they did. I'm glad I wasn't going there this week. It's supposed to be in the 40s for the next week, so I'm hoping it all melts off by the time I get there.
Yeah, we had 2 council members that were supposed to go to DC this week for the NCAI, and we canceled it because it was too scary.
Yeah.
That was right during the storm, the blizzard.
Yeah, I would not want to be traveling there this week, that's for sure.
Yeah. Well, have safe travels. Bye.
Thank you. Bye. Have a good night. Good week.
Have a good night. Have a good week.
Thanks. You too, Austin.
Have a good trip.
Thanks, Valerie.
We sit right up there next to where I was parked.